Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Every now and then we like to peruse the headlines and see what's going on in the world and what does that mean to us as real estate investors. We call it Clues in the News, and we've got some great articles today on the Real Estate Guys radio program. All aboard! A few cabins remain for the Real Estate Guys 16th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year are sales legend Tom Hopkins, the authors of Prosper, Chris Martenson and Adam Taggart, Sovereign Man Simon Black, editor of the Gold newsletter Brian London, and the author of The Creature from Jekyll Island, G. Edward Griffin. Plus, joining us for a 6th Investor Summit, Peter Schiff, and back once again, Robert and Kim Kiyosaki. It all begins April 6th in Fort Lauderdale. Visit realestateguysradio.com and click the tab that says Summit to learn more and reserve your spot. But you better hurry. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Robert and Kim Kiyosaki, and an all-star faculty on the 16th Annual Investors Summit at Sea. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. With me as usual, it's our financial strategist and co-host, Russell Gray.
Hey, Robert.
He is also the news peruser, always looking at the headlines and reading stuff that makes sense. When it comes to real estate, there's lots of specific information we read about and hear about and listen to, and then there's other articles that have an effect on real estate. So today, it's a show we do from time to time called Clues in the News.
And it's pretty eclectic. You know, I read an interesting article about Warren Buffett, who, most people have heard of, the Oracle of Omaha, one of the most legendary, if not the most legendary investor ever. And he spends 80% of his day reading.
Yep.
He spends 80%. So I don't feel so badly about my obsessive compulsive behavior towards reading the news, but there are really so many interesting things going on in the news. And when you read financial news, business news, industry news, and I subscribe to accounting journals, so I read things that CPAs are reading about what's going on with the tax code and how it's being interpreted and different things like that. Commercial real estate publications, of course, reading just the general financial news, what's going on in the stock market, the bond market. What is the John Q. Public reading about, the person who's sitting there monitoring his 401k and going through a stock market roller coaster, now Bitcoin. And so there really is a lot of information out there. And of course, most of the time, in fact, I would say all of the time, even at some of these real estate-centric places, they're writing to people who aren't you. If
Right.
you're a mom and pop investor out there and you're buying real estate, maybe on the side, you have a few rental properties or small multifamily, they're really not writing to you. Everything, when they talk about real estate, they're talking about REITs, they're talking about the housing industry and the stocks behind it. They're often talking about everything from the concept of buy low, sell high. They very seldom focus on cash flow and yields. And yet in a low interest rate environment, which we've had, people have been chasing yield. That just means that when someone goes down to the bank or they're going to buy a bond or they're going to invest for income and insurance annuity or whatever it is, they're looking at these itty-bitty yields and they can't get their equity, their portfolio, whether it's in stocks or whatever it's in, to generate enough cash flow. Sovereign wealth funds are having this problem right now. And so even people that would traditionally not look at non-investment grade product or non-registered securities are beginning to have to go out to what we call the margin. They have to kind of go out to the fringe a little bit and look for things. So you're seeing it as individual investors, multifamily investors in the apartment space. They're finding that the cap rates are squeezed in the prime areas and they're having to move out. Developers are finding that same problem. So we're seeing a lot of things that are being told to us about what's going on that are reflected by the behavior, the way people are approaching markets and asset allocations.
So we're going to cover a bunch of different articles. We probably won't have time to get to all of them. And your mission is to listen through and think, how does this apply to me as a real estate investor? We're going to start with some really big picture stuff. There are a half a dozen articles in the last 10 days about U.S. mortgage rates headed up. For the third week, for the fourth week since last month, mortgage rates are headed up, and many experts are predicting that mortgage rates are going to continue to go up. So you read that and you're like, okay, well, mortgage rates, that certainly affects real estate, and they're talking about single-family mortgage rates.
Right.
They're not talking about multifamily or industrial or any of that, but of course some of that does follow suit. So the big question from a real estate investor's point of view is, if that were true, if we knew for certain interest rates were headed up for the myriad reasons out there, what do we do about it?
Well, I mean, you do what we've been saying for a long time. You buy a deal that makes sense today, you lock that interest rate, and every day that interest rates go up for people who are acquiring after you, you now have a competitive advantage. If you're using debt to acquire income-producing real estate, one of your number one cost inputs is interest. And if you have locked in a competitive interest rate, that's like when Southwest Airlines goes out and oil takes a dip and they buy futures contracts to lock in their gas pricing for a year. If the oil price goes back up and airline fuel goes back up, they've now locked in a lower cost. It gives them a competitive advantage. One of the most important things any business does in any industry is look at its components of cost, its cost inputs, and use strategies to try to manage that and give itself a competitive edge over competition who are less diligent.
Now, there's an article here that says 6% of mortgages originated last month approximately were adjustable rate mortgages, and the rest were fixed. Now, that makes sense. When you're at a low interest rate environment, you are probably going to want to secure fixed rate interest. Now, what's the difference? Well, an adjustable rate mortgage starts at a lower rate, and it can adjust, not necessarily higher. Sometimes it adjusts once maybe an early teaser rate or whatever. It'll adjust according to the market. And I remember there were times in our career where we would look at the market and say, you might want to consider an adjustable because relatively fixed rates are high. Last few years, of course, relatively fixed rates have been low, so that's no surprise. The surprise is the change. There's an interesting article that came out mentioning a survey done by Redfin, and they were posing a question to people actually in escrow to buy houses, that if the rates were to go up above 5%, would they cancel the purchase if they could? And surprisingly, 6% of the home buyers surveyed said, yeah, if it went over 5%, we'd cancel. But 94% said, no, we'd still buy.
Yeah, well, it's interesting because, way back in the day, I did a little analysis, looked at interest rates from 1977 all the way to mid-2000s. This was pre-crash. And even though, and this was national averages, so in any given market, it could be different. But whether interest rates went up or down, it really didn't matter. The average housing price went up. So, of course, those are just averages, and, your mileage may vary depending on the situation that you're in and what you're looking at. But here's the point. Interest rates is only one part of it. So you have to look at what's going on with the interest rates and the impact that that is going to have, not just on you and your mortgage, but the impact that it is going to have on your tenant. Because typically if mortgage rates are going up, so are credit rates. And if your tenants are carrying credit, now they're being squeezed with that. If you marry that to an environment where rents have been going up because of strong demand, and now you've got high cost inputs in the form of higher interest rates coming up, now you're going to have higher rents to cover those higher mortgage rates. Well, that could eventually squeeze your tenant. So if your tenant doesn't have good solid income, if you're not in a good solid market, you're not going to be able to push those rents, but your cost inputs could begin to go up. So you have to be very, very cautious, especially for multifamily investors, because they're not locking in for 30 years. I mean, if a really good one, maybe 15.
Right.
So a lot of times these things are 10-year loans. And if you're in a truly long-term interest rate rising cycle, and I'm not saying we are, it's hard for me to imagine that we could be with how much debt we have. I feel like the bigger concern is just the strength of the dollar. And if people lose faith in the dollar, yeah, interest rates will go up to compensate. But the dollar's been on a 100-year slide, and interest rates, everything stays kind of stable and moves slowly. We should be happy about that. But the issue is wages. If rents are going up, continue to go up at a rate that is higher than wages, at some point, those tenants are just not going to be able to afford. Now, if you're at the top of the market, you're in trouble because there is nobody. The top of the market, like multifamily, that's a little bit scary place to be, I think. Because first of all, it's thin from the get-go, just to start with. Number two, they're overbuilding because it's the only place they can get the rent and the prices they need to cover the construction costs. So now you have a supply thing. And if you marry that to a weak wage growth economy, there's nobody above you to move down. So you're all there by yourself. Now, if you're below that, if you're like in the B and C class, the people who used to be A class who can no longer afford it can begin to come down. And so these are the things you have to be thinking about strategically. We're just talking interest rates and debt markets right now. But remember, the debt service is a function of income, both your income, which is the tenants, but the tenant's income, which is their job and wages.
The big picture on interest rates is that you just need to pay attention, especially if it's a fixed rate environment. When lots of folks were in adjustables, I tell you what, those students were paying attention to where interest rates were going because they would say, hey, I've got to consider refinancing if my adjustable rate's going to go high. But when you lock and leave, you just put a fixed rate loan on a product. You're like, well, okay, whatever. I mean, at some point I might want to refinance, but there's that whole other story, which is the minute you refinance, you just reset your amortization. So do the math. But I think big picture is when I see something like a headline after headline after headline after headline, all saying and predicting interest rates are not only they're going up, but experts are predicting they're going to go up, the point on the curve, right? Now, it's not the same everywhere. And the reasons aren't the same everywhere. It's not just what the interest rate is, it's how easy can you borrow the money.
Right.
There's been ease of borrowing and there's been difficulty in borrowing over the last many, many years. Article came out in Canada. This is interesting. A news station in Canada said the Office of the Superintendent of Financial Institutions has introduced new rules on mortgage lending that'll take effect and that there's a new minimum qualifying rate. What this basically says is that it's harder to get a loan on a single-family home in Canada than it has been. So the article goes on to talk about the fact that they're expecting more tenants in Canada across the board because less people can become homeowners.
Yeah, that makes total sense. I mean, if you think about what's going on in the Canadian market with just explosive appreciation and then explosive depreciation, now you've got people who are gun shy. So why buy when you've seen the pricing come down? You might want to wait till it bottoms, and then if you're a lender that's seen that go on, it's a little concerning, right? Because you can see that protective equity that you got, the down payment, the owner's equity, that getting thinner. If it gets too thin, the owner goes, you know what, here's the keys, I take the property, I'm not interested. And at that equity level, the lender's not interested in it either. So they're going to tighten up their guidelines and make sure that they have people with more skin in the game, with more solid income, with better credit, better balance sheets. I mean, that just makes a ton of sense. It's the same thing that happened here in the U.S. After 2008. The lenders were much stricter on the guidelines because they had to be.
Right. So again, disciplining ourselves to step back and say, good news or bad news. To me, when I see that fewer people can afford to buy houses, as a landlord, I'm happy.
Well, 2008 was a huge boom. I mean, look what's happened to multifamily since 2008. That is a direct reflection of what happened to single family.
And what's going to happen to multifamily? Well, our next article is going to talk about that. It's clues in the news, what the headlines are saying, and what that means to you as a real estate investor. Today on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Homebuyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
For investors, timberland has become the symbol of safety. Global tropical timber demand continues to surge as the world's population increases. The need for managed, sustainable timber production forests has never been greater. When stock markets crash, trees keep growing. Direct ownership of fully managed tropical timberland acreage is now available to accredited investors. Prime valuable hardwood groves close to the beautiful Costa Rican border generate and maintain superior long-term wealth. Qualified, accredited investors should email timber@realestateguysradio.com for more information. Consider visiting our forest plantations to see for yourself. Email timber@realestateguysradio.com. This announcement does not constitute either an offer to sell securities or a solicitation of an offer to purchase. Offering made by prospectus only. For more information, email timber@realestateguysradio.com.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station all the time at realestateguysradio.com. We're discussing some clues that are in the news. We like to check out what's happening in the news and then really interpret what does that mean to real estate investors. And we were talking before the break about multifamily. And of course, last week we had Brad Somark on the program talking about the multifamily markets and what's happening there. But there's some unique things happening. And there was an article that came out at CNBC that actually launched a whole bunch of other articles about some discoveries being made in development of new multifamily.
Yeah, well, I mean, so we're paying a lot of attention to multifamily right now because it's been a sector that has attracted small investor money, institutional money, a lot of lending money. And so when a lot of money is pouring into a sector, the big question is the sector overheated? Or the market overheated? Is the opportunity over? The cap rate's too squeezed? The other thing is we talked about prior to the break, we've got the situation where interest rates are rising. Well, that's okay if you've locked in 30, but if you've locked in 10, like a lot of multifamily, you need to be a little bit more careful. The other thing is your tenants in that asset class, typically, especially in the middle income, they don't have big balance sheets. They don't have big savings accounts. They're carrying debt, and they're impacted more by inflation. They're impacted more by interest rate changes because they're carrying the debt. And so you have to pay attention to what's going on and what it's going to mean to them and your demographic. This article by CNBC, written by Diana Olick, who is their real estate gal that covers all this stuff, been reading her for years. She interviewed a major apartment developer, and he says there's an acute crisis headed our way. Okay, well, that gets your attention. That gets your attention. And she bullet points three things. The luxury market is largely overbuilt. Well, there is a shortage of affordable rental housing.
Yep.
And there's a reason for that. She breaks into it, and we had that same conversation with Brad last week. And so we've heard that and seen that. And that is that it's hard for the middle-income builders to build something with today's labor, today's land costs, today's energy costs, today's material costs.
If you were a builder, would you rather develop something for low-end, low-margin, or high-end, high-margin? To me, as a developer, I'm looking out there going, man, I'd like to sell to affluent people that got plenty of money where I can have lots of upgrades and lots of charges, and they'll be thrilled to death, and they can afford it, and they've got cash, and a lot of developers are doing that. So what's getting built? What's getting built, and new construction permits are continuing to go up in lots of these popular areas, are Class A, beautiful, fabulous luxury apartments. And you know what? There's a group of folks that can afford those. But that's not really the inventory that we need as a whole here in our nation.
Well, again, you've got the dynamic because the real affluent people are buying. So you're talking about affluent renters and apartment renters. And apartment renters are different than families. So you're talking about a very specific demographic. And then you have to ask yourself, is there wages going up? Is the interest rates that they are paying, are they going to be able to afford that? And then if they can't, who's going to replace them? Because there's nobody above them, as we mentioned earlier, to come down. And then you've got the overbuilding situation. So that when you talk about multifamily, that's the upper end multifamily, which is a different market, even though it's multifamily, from the middle market.
Well, not only that, the people that invest in that market are different. When we meet a lot of apartment investors, that's not what they're buying. Who buys that stuff? Well, first of all, when you build luxury, you don't really get better returns. They're lower returns, but in the minds of the investors who invest there, safer returns. There are lots of folks who invest in A-class apartment buildings because they want security, and they might get a 2.2 or 2.4 or 2.8% yield. But they're not individuals. They're pension funds and REITs and insurance companies and those people, and they're happy with that, the nice, clean, pristine asset. Where the demand, though, is for the folks that service the people that live in those buildings. The B-class building, the C-class building.
Right.
That's
exactly.
where the demand is.
Sorry, I was fixed. Do you ever see the movie? I don't watch a ton of movies, and haven't even seen the whole thing. Pineapple Express?
No.
Okay, he says safety first, then teamwork. So to me, the investors who are investing in Class A is safety first, then yield. In other words, they're much more interested in the protection of the capital by buying a quality asset, and they're willing to settle for less yield because they're not trying to grow the wealth as much as they're trying to protect it.
Now, here's a really important point in what you just said. When you approach real estate investing, never assume that everybody is just like you. The very reason they invest is not the same reason you invest. Most of our listeners are wanting to earn more money. They want to build their wealth. It's like Robert Kiyosaki told us on the summit last year. Hey, I don't have the same problem you have. My problem isn't getting rich. I'm rich. My problem is I have to put my money somewhere so it's working. I don't need to take the same risk. I want to be in great solid deals, and I don't need the same yield. Right? We think, well, I want to do a deal. I can easily find 15, 20% return deals, and many people listening to this show can. But a lot of the uber wealthy don't want those kind of deals.
Yeah, well, to go off the rails for just a second, had an interesting conversation with a gentleman at a show a couple of weeks back. And one of the things he said to me was, we were talking about the topic of syndication, the opportunity to go bigger, faster, syndicating. He goes, yeah, I kind of like the idea and it's interesting, but, I couldn't really do it because I would never want to invest in a syndication. And I said, well, it's great that you would never want to sell something that you personally wouldn't buy, but the person you're selling to isn't you. The person you're selling to doesn't want what you want. The person that you're selling to would never, ever, ever, ever want to do what you do. They would not want to go drive neighborhoods looking at properties. They would not want to make offers. They would not want to haggle on prices. They would not want to have to deal with repositioning tenants and rehabbing. They don't want to deal with any of that, but they like the asset. They understand the fundamental demand and need for real estate. They understand the financial model underneath real estate. They know that even modest yields and modest growth with leverage can produce outstanding internal rates of return. They understand it, but they don't know how to do it. So there's a huge opportunity as a syndicator to step in and do that. Part of the reason we watch the news is because the syndication group that we work with and talk to all the time, we're trying to help them understand the economic world that they're making business decisions on behalf of their investors for. Now, we don't give them, investing advice or professional guidance. These are just ideas and information. But a lot of information is readily available. When I read that Warren Buffett spends 80% of his time reading, a lot of what we are talking about is the kind of thing he's looking at. He's trying to figure out, reading the tea leaves, where the best opportunities are going to be and get in ahead of the curve instead of chasing.
Right. So the point of the fact that there's a lot of explosion in the high end of the apartment space doesn't mean that's what you should go invest in. What it means is that builders and developers see opportunity, and their answer is, in order to make the margins they need to make, I want to build higher end stuff. But for us, we are going to see a lot of opportunity at the lower space, and nobody's building a new C-class apartment.
Well, and that's the point. So the problem in the A-class stuff is it's overbuilt.
Yep.
The problem in the B and C class is it's underbuilt. There's not enough inventory, and there's more demand for the inventory because as the upper end continues to get raised up, the people who are already there can't afford the raise, so they have to come down. And so you've got that. So in a good economy, the people who are below that, or the people who are living with mom and dad or whatever, they're coming into the space. And in bad times, people are coming down from on top into the space. And so it's a very, very great place to invest. It's where Robert Kiyosaki loves to invest with Kenny McElroy. It's what Brad Sumrock, the apartment king, does. And so it's a great, great place to invest. But the world has figured it out. And so that's one of the issues is you just have to make sure you got to tighten your criteria a little bit. You need to sharpen your pencil a little bit. And what we alluded to earlier, I want to be very clear. There's a time that you need to be aware. Am I ahead of the curve? Am I riding the wave? Or am I chasing the yield? Am I chasing the market? When you get to the point where you're chasing the market, and you're having to stretch and have, over optimize or be more optimistic with your assumptions than you normally would do in order to make the thing pencil on paper, then you're taking some plan Bs and Cs out of your game plan when you actually go to operate the property. And if something you didn't expect happens, you don't have as much wiggle room. So,
well, one of the things last week, if you haven't heard that show, go back and hear it, that I loved about what Brad had to say was that you have to change your expectations when the market changes.
Exactly.
When we first met Brad, he was talking about, hey, in our program, a lot of people are doubling their money in 5 years. I buy an investment that's an apartment building with partners, and in 5 years, I can expect to double my investment. Based on this cap compression and chasing yield and less availability and all that, he's revised that. He says, today I say it's 5 to 7 years. Back then, it was 3 to 5 years. The idea of investing in apartments and providing housing for people hasn't changed at all. But because of interest rate and demand and supply, expectations have to be changed.
Yeah. And the other input here that is the third bullet point, coming back to our CNBC article, it says nearly half of all renter households pay more than 30% of their income for housing. And later down in the article, it talks about whatever significant percentage is paying up to 50% in the lower end. Well, these are people that don't have any wiggle room for inflation. The price of gas, they're floating the idea of a national gas tax. Now, I'm not going to comment on that politically, whether that's a good idea or a bad idea, but at the end of the day, the people who are going to feel it the most are your tenants.
Yeah.
They're going to be the people at the bottom who are commuting back and forth to work, and, an extra 15 cents or whatever it is per gallon for them, that's a big deal. That's a big deal. When you raise somebody's health insurance premium by $100 a month, that's a lot. These are people who will move out of your apartment for a $25 a month increase. So you just have to be aware of all the different inputs, not just into your P&L, but also into the P&L or the cash flow of your individual tenants. And so these types of studies, when these articles come out, it isn't the answer. It's the start of the research.
Yeah.
And then you have to dig down into your own individual market. Some of that is going to be stuff you can find online, and there'll be reports. Most of that stuff is in the rearview mirror. You're going to read news articles where people are interviewing people who are notable, and maybe you can begin to follow them, and they put out newsletters and they have stuff on their website. They tweet, whatever. You follow them. That's a little bit thumb on the pulse. But if you're really serious, you need to be in touch with your boots on the ground team and be talking about what are you seeing at the street level, because the clues will be there. Your dad, Bob Helms, says all the time, the information about the relationship was available at the beginning if we will heed the clues, heed the warning signs. Well, the same is true in your investments. Most of these train wrecks, when they're coming, and again, you say 2008 was an awful train wreck. It was for me because I wasn't as studious as I am today, right? I was only geared for sunshine. With that said, many, many, many people made tons of money coming out of 2008. So just because the economy is quote unquote bad, it doesn't mean the opportunity for you to build wealth is bad. In fact, many times it can be even better, but you have to understand what's happening, what's likely to happen, and then what you need to do.
It's clues in the news today, articles that we're reading, and what that means to us as real estate investors. We've got more when we return. Plus, we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Imagine listening in as two real-world apartment investing experts share their best ideas and strategies. Well, now you can. When you listen to the Old Capital podcast featuring Michael Becker and Paul Peoples, you'll learn from two seasoned pros who funded and syndicated hundreds of millions of dollars in apartments. Each episode is chock full of expert advice, real-world wisdom, and interviews with real-life investors. For details about how you can listen to the Old Capital podcast, send an email to ocp@realestateguysradio.com. When you do, we'll send you Michael Becker's personal due diligence checklist free of charge. Email your request to OCP, Old Capital Podcast, @realestateguysradio.com.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio show. I'm your host, Robert Helms. It's clues in the news. We're looking at the headlines and what the news is telling us, and of course, interpreting what we think that means for us as real estate investors. Before we get back to the headlines, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's real estate trivia question. In just a minute, I'm going to give you a question that has something to do with real estate. As soon as you hear the question and think you know the answer or just want to guess, send your best guess to trivia@realestateguysradio.com. trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address, because if you're the winner, we're going to send you an amazing book called Passionistas: Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That can be yours if you know today's trivia question. Last week on the show, we had Brad Summerock on the program summarizing his 2018 apartment market forecast. We asked this: name the only U.S. state in history to turn down the Olympics. Well, it's the grand state of Colorado. Back in 1976, the Winter Olympics were planned to be held in Denver, but 62% of all state voters chose at nearly the last minute not to host the Olympics because of the cost, pollution, and population boom it would have on the state of Colorado and the city of Denver. Here's our real estate trivia question for this week. Where is New England's oldest stone house? You know, back in New England, a lot of the homes were made out of stone. Well, where's the oldest one? If you know, or want to guess, or I don't know, maybe you lived there, let us know by sending an email to trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address. If you're the winner, we're going to send you Passionistas: Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That's today's real estate trivia question. We're talking today about clues we see in the news. We like to look at various sources of information. We like to look at some of the more fringy stuff, but also the Main Street stuff, because that's what people are reading and getting kind of underneath the headlines. This headline came from Bloomberg, February 16th. Wall Street's home rental bets shift to lower-end U.S. houses. As Wall Street's rental home industry matures from its early days of frenzied home buying. And by the way, when they're saying Wall Street's rental home industry, this is the big buying that came by all these big groups, all these big hedge funds that came in and bought all this inventory that was created from the crash when people lost their houses.
Yeah, exactly.
So they got in a big way. So apparently after this, they were really concentrated on a particular segment in the market, and now they are lowering their expectations.
Well, I just have to make this one comment because it just is amazing to me how unabashedly the financial media just admits that Wall Street is a casino.
Yeah.
I mean, they say it all the time. Everybody, they place in a bet. They're betting on this. They're betting on that. What they're doing is they are speculating.
They say taking chips off the table.
Yeah, I mean, they're just putting money into the market. They're using the 100% buy low, sell high on things they don't understand, can't control, and they're just trying to get lucky. Now, they're educated bets, right? Because people are predicting what they think is going to happen. But at the end of the day, you don't really know. I think the thing that's beautiful about real estate, if you stick with bread and butter real estate, and when I say bread and butter, I mean anything that's fundamental. I mean, I think agricultural real estate is bread and butter real estate because for the foreseeable future, I'm guessing people are going to want to eat.
Yeah.
Housing, I would consider to be anything that is supporting basic functions, hospitals, even entertainment. There's a lot of things. Now, industries like retail, we've seen what's happened, so things can change. When we had the decimation in the single-family home space, Wall Street saw the opportunity. Warren Buffett famously came out and said, hey, if I could buy 200,000 single-family homes, I would. Well, why couldn't you? You're Warren Buffett. Well, yeah, because I can't go to my office and push a button and place a buy order. So it's to aggregate that kind of inventory is heavy lifting. But more enterprising people who were willing to do the heavy lift did it. We know because we dealt with the other end of that as these hedge funds got formed. They were out working with many of the providers that we deal with in Main Street markets and were having them source this inventory. And it made sourcing inventory for the mom and pop investor very difficult. Well, now these bets, so to speak, their positions in these marketplaces have matured a little bit.
Right.
And they're realizing that their margins are a little bit thin. And in order for them to see where they see a better opportunity, they're moving out to the margin. And when I say the margin, you've kind of got the center mass of what you're aiming at in terms of what you want in return and safety profile, the risk versus reward. And then when the yields in the quality assets begin to go down, then what happens in any investor class, when people are trying to figure out how can I maintain higher yield, they have to accept higher risk. And so that's what I mean when you hear anybody talking about things going out to the margin. So what they're doing is they are moving into low income marketplaces which are normally, hard to take on, but they're doing it because they have to in order to try to pursue the higher yields. It's the same thing that the mortgage industry did when they moved into subprime, because the prime borrowers, it was too saturated and they had to go out to the subprime.
Yeah, the article goes on to say, when Wall Street companies started buying homes in mass in 2012, they mostly avoided focusing on properties aimed at poorer tenants who tend to be less financially stable and more transient. Plus, cheaper houses often require more expensive repairs. They use the example of a new roof or refrigerator costs the same whether the house is renting for $1,000 or $2,000. So they would focus on houses that would rent for $2,000. Again, not thinking necessarily like an investor.
Yeah, because we'd be out there buying used refrigerators,
Exactly. Right, but that's not how they think. But now, in order, again, to find that yield, just like we see apartment investors go to the tertiary market, we see these big funds going to less expensive houses in more difficult neighborhoods.
Yeah, now you can front run them, right? Because they move slowly and they talk about what they're going to do because they publicly, they're always talking about their strategies to attract investment income. People are tracking what they're doing. And so it is possible to get in front of them. Now, again, I wouldn't develop a whole market and investment strategy off of a news article. It's the beginning of additional research, but it gives you an idea what the big players are doing. And if you can position yourself in a way where when the big money moves into a space, you're already there. It's great. Like we talk to Gene Garino all the time. He does a residential assisted living space. Residential assisted living takes a single family home and turns it into an absolute cash cow. I mean, it's just ridiculous because it's not just a tenancy. You're operating a real business in there that has a high amount of cash flow relative to the price of the real estate. And because of the nature of the business, the tenant, who's the operator, could be you if you're your own tenant, is going to end up wanting to sign a longer term lease because they need the kind of stability that a business needs. Businesses typically sign longer leases because they're establishing a geographic presence in a market. They don't want a year-to-year lease. They want a 5-year lease or a 10-year lease. So imagine a 10-year lease with a whole bunch of extra income. Pretty good, right? Yeah. Well, the problem is that when you got the big players out there on Wall Street, high yield, high quality assets don't last very long when they figure out how to step into the market and buy them. So the idea, when I get a chance to go talk to Gene's classes, he does these fast track trainings in Phoenix. And when I get a chance to go talk to them, I try to explain to people, in my opinion, it's just my opinion, I just think the opportunity to get into a space before it's consolidated, knowing that those high yields will not last very long. I mean, it could be 2 years, 3 years, 4 years. One day, Wall Street's going to wake up and they're going to go, hey, there's huge yields in this space backed up by quality assets, and they're going to put a bunch of money together and they're going to go bid those things up, which is great if you already own them, which is my point, and buy them. And then they'll look for operating efficiencies or whatever to bring the yields back up. But these are the types of things you can see if you're paying attention.
It's clues in the news, what the news sources are saying and what that means to us as real estate investors. We'll have more when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show today. Tell a friend about the Real Estate Guys, and then get that friend and come out to Fort Lauderdale for the future of money and wealth. Super excited to have Robert and Kim Kiyosaki with us for 2 full days, plus Peter Schiff, Edward Griffin, all kinds of amazing folks. It's a 2-day event that is right in front of our summit at sea. In case you can't manage 10 full days at sea and the big price tag of a cabin, but you want to come out and hang out with those folks, it's the future of money and wealth. You can find out the details on the website, futureofmoneyandwealth.com, or go to realestateguysradio.com and look under events. It's Clues in the News, and we're looking at some interesting news headlines. This is an interesting one that you found, Russ, about technology.
Yeah, so a couple weeks ago, 3-4 weeks ago, whatever it was, we did an article just talking about industrial and office.
Right.
And what was going on in industrial and office and the shift, because it's the reflection of the retail apocalypse, if you will, the job sharing economy, the virtual workers. So there's different things going on. And of course, Amazon's HQ2 hunt has everybody speculating what market is going to land this big gem and get $50,000, $100,000 a year jobs and, really change the financial footprint. So, you're looking at that. And then the other thing is that back after 2008, Kenny McElroy taught us this, and he went after energy towns because he felt like energy was the play. And that was a brilliant play at the time. Oil was going up. It got all the way up like $140 a barrel. And you had these oil towns that were just booming and debt was coming in. And so money was coming in on the debt side, it's coming in on the equity side. They were generating huge cash flows. And it was all good, right? And Texas was the big leader in the employment creation, and of course the politicians all like to take credit. For the end of the day, God put the oil under the ground. And
well, it's not just the oil; it's every business and every industry that serves those industries and those marketplaces that have other big industries in it. So it continues to roll upon itself.
Yeah, and so then oil goes from 140 all the way down to like 28. And so it kind of flips over a little bit. Now, so that's why we never went into North Dakota, because that was a one-trick pony. You had oil. And when oil went down, North Dakota went with it. Whereas, Texas and Dallas and Houston felt it worse than Dallas, but Dallas was a very resilient market because it combined the distribution. It also was a huge metro with tech and lots of infrastructure, medical, education, all the things we look for. So anyways, this particular article, to come full circle, says tech firms continue to seek out new markets for expansion. And here's the reason. It starts out, as the U.S. economy continues to evolve, the high-tech sector is growing at 4 times the rate of the national economy and is expected to generate 9 million new jobs between 2012 and 2022. So some of those jobs have already been created, but a lot more are coming. That's all coming from the U.S. Bureau of Labor Statistics, at BLS. So now they're talking about some of the different markets that are being affected by this. Now you may say, well, yeah, but I don't invest in office. Yes, you don't. Maybe you don't. But if you invest in residential and your people go to work in offices,
right,
then you invest in office indirectly. And office
absolutely
affects you.
And if an industry is going to put people somewhere, they have to live somewhere. Hello.
It's a leading indicator. This was the point of the newsletter a few weeks back, that you look at these distributions where warehouse space, because of the move from retail being walk-in traffic and pick it up and all that, to now everything being ordered online online through Amazon.
Well, not everything.
Well, a lot of stuff, right? Being delivered. I mean, you're not going to get a massage and order that online, and things like that.
I'd stay away from that site.
Yeah. But you can see now where the job growth is going to be. It's just like when we go into a market and we look around and say, okay, we're going to go out and drive around kind of the fringes a little bit, not get out of the mainstream, go a little bit out to the margin, driving around, and we see McDonald's and we see Costco and we see Walmart, and we start thinking, well, there's really not enough people here yet. Not enough people here yet, but obviously somebody knows something because the freeways are in and this major piece of infrastructure's come in.
Well, those companies you mentioned don't just say, we got to put a store out there just in case people show up. They have done the research to know where people are coming.
Yeah. So, but then you understand what's going on with retail and how many stores are closing now. Yeah. Sam's Club is being converted into distribution centers, no longer walk-in. That's really interesting. Of course, we all know what's going on with malls, led by the demise of Sears and JCPenney and now Winn-Dixie. So you see a lot of this stuff going on.
Starbucks seems to be doing okay.
Yeah. Well, so like I said, basic human needs. But when you look at office and realize, okay, so if we can find an area, if we think this is great, okay, so certain tech jobs can get offshored. We've seen that. We've been in Silicon Valley and observed Silicon Valley long enough to see that. But right now, there's a lot of tech growth in the U.S., and we have a political environment that's trying to attract people back in. And so if that continues to be successful, then the idea that this hot sector, plus you've got these big third world countries like India and China in particular that are large consumers of tech, it bodes well for the U.S. economy specific to tech, just like the U.S. energy industry looked real solid right after 2008.
Plus, if you look at the markets where there is a lot of tech infrastructure now, generally those housing prices have inflated. Those are high-end markets.
Yeah. And so here's the thing. If you're trying to be a strategic market selector and you realize that the tech sector is growing by 4 times, you have to ask yourself, what are tech CEOs thinking about? This is why we're watching what's going on with Amazon, because Amazon is one of the FANG stocks. It's one of the top rated, top followed, top emulated, top watched tech firms. And so they're going to tell us what they're looking at in a market.
Yep.
Now, we kind of know already because they put it out in their request for proposal. And, we kind of went out on a limb and picked a market. I mean, if I had to bet right now, I'd say it's either going to be Atlanta or Dallas. Those are, what I would consider to be the two front runners. This article talked about one of the fastest growing tech markets in the country, Phoenix.
Yeah.
Phoenix is an emerging tech hub as the number of people employed in tech occupations over the last 5 years has grown by 48%. Region has a relatively low cost of doing business, an affordable cost of living, and several universities. Tech needs intellectual talent.
Yep.
I remember Silicon Valley. My dad went to Stanford, and Hewlett-Packard was kind of the beginning of Silicon Valley. And they were pulling smart people out of Stanford University and putting them into tech, and that gave birth to all kinds of stuff that went on. And that's what it is when they talk about a hub. And this is talking about getting critical mass. There are industries that need to be around other activities in order to be efficient and effective. Like when we go into Memphis and look at what's going on in Memphis, there are certain industries that locate in Memphis purely because FedEx is there.
Yep.
And they can get things shipped all the way. They can go to the FedEx store not at 5 o'clock, not at 6 o'clock, at midnight,
right,
and still have it make the plane and be delivered next day.
Yep.
And that's the only reason they're there. So when you get down to the granular level and understand the business, where the business growth is. So the office space tells you the markets that people are actually committed to. They're not just shopping anymore. The office is coming. Now you have to know the difference between spec. Some people will guess, right? There's offices popping up in towns right now because the builders in those towns think they're going to get Amazon.
Right.
And they want to be in front of the curve. And so they're placing their bet, so to speak, because that's what speculation is. But when you start seeing leases being signed, now you know. So this is going to be a very interesting story to be watching.
So, we could go down this path and talk about this stuff forever, but you're getting the idea that you need to pay attention and read between the headlines. If it's clear that there are big shifts like this, how do I get in front of them?
Exactly. I mean, that is the key. And so you read it in the news, it's the starting place, and then you maybe want to go visit the market or begin to monitor the market, the local business journal, and start paying attention to the local news. Get into trade. If you're looking at a particular industry, there's trade magazines, trade shows. We learn a lot when we go to trade shows, and we get a chance to talk to people who are thought leaders in their industry, who are trying to solve the problems of the industry, who are reporting to industry observers where their industry is headed, what they're looking at, whether it's the Mortgage Brokers Association, whether it's some tax or estate planning convention, whether it's a specific multifamily apartment association. So many different places you can go. But the point is to be a strategic real estate investor. Like Warren Buffett is a strategic investor, you want to spend a lot of time informing yourself. Obviously, we're preaching to the choir, because if you've listened this far into this episode, you're probably one of those people. But if by some chance you're listening to this show and this is the first time it's ever occurred to you that you should be reading the news, even news you don't think directly applies to you, and asking yourself, how does this apply to me? But even more directly, how does it apply to people and businesses and the moves they're going to make, and the demand and supply balance and imbalance of both capital and product type and rental demand, and how can I put myself in a position strategically to take advantage of it, so that even if I make a mistake on my investment, even if something doesn't go quite as scripted, I've got the strength and the underlying dynamics, drivers of the market to support me. There's a lot of people that can be very, average investors, and if they happen to land in a superior market, that market will save them. And that's what I love about real estate, and why I think picking the right market is every bit as important as picking the right property.
So there's a bunch of news, bunch of headlines, bunch of things that influence us as real estate investors. Keep paying attention out there, and we'll keep checking for clues in the news. Hey, there's still a few cabins left for the 2018 Investors Summit at Sea. It's going to be an amazing time and a super amazing faculty. Peter Schiff is with us again, Tommy Hopkins, Chris Martinson and Adam Taggart, Simon Black, and Robert and Kim Kiyosaki. Get all the details on our website at realestateguysradio.com under events. Next week, we start a multi-week series on different types of real estate, different asset classes within real estate, if you will. We've got some great guests and some great topics. Until then, go out and make some equity happen.
Hello, this is Robert Kiyosaki, and I'm very excited that I'll be joining the Real Estate Guys for their Investor Real Estate Summit at Sea. Join me, join my friends, join the Real Estate Guys Investor Summit at Sea, and I'll see you out there. Thank you very much.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.